When you leave the UK and become a non-UK tax resident, you might think that your UK tax situation is finished. But even then, if you've met the statutory residence test and stopped paying UK tax on most overseas income, there are still UK tax reliefs that you can lose, and they can be significant. If you're new here, I'm Abbas, a chartered accountant and chartered tax advisor. I work with clients moving abroad to make sure that they don't lose valuable tax reliefs that they didn't know they even had. Now, one big one is private residence relief, which can exempt your main home from capital gains tax in the UK. Now, as a non-resident, you can only get it if you meet the 90-day occupancy rule, meaning you've spent at least 90 days in the property in a tax year. The catch? Spending that much time in the UK could make you a UK resident again under the statutory residence test. And even if you don't qualify for the relief, UK property is always subject to UK CGT for non-residents. If you're planning to sell your home after moving abroad, it's worth getting advice before you leave. Selling while still UK tax resident could save you a lot of tax. And don't forget, if you do sell, you must report it to HMRC and pay any tax due within 60 days. The other major one is EIS and SEIS relief. Non-residents can't claim income tax relief or CGT deferrals on new investments. And if you've already claimed relief and leave within 3 years, HMRC can claw it back. And if you've used EIS to defer a gain, leaving can trigger that gain to be taxed immediately. So if you're leaving permanently, you might not care. But if you're coming back in a few years, timing your move and planning your transactions around it can make a huge difference. In the next video, I'll explain how leaving can affect your UK company and why you could end up paying tax in 2 different countries if you don't get it right.